Imagine this: you close a deal with a client overseas, the payment hits your account, and for a moment, everything looks perfect. Then you check your numbers and realize something doesn't add up. A large portion of your income is gone, not because of expenses, not because of bad planning, but because two different countries have taxed the same income, one where you earned it and another where you live. This is called double taxation, and it's one of the most common ways people silently lose money in international business. Freelancers, consultants, remote workers, investors, and even small business owners face this problem every single year. The worst part is that many of them don't even realize it's happening. They assume it's normal, but it's not. And more importantly, it's avoidable. To understand why this happens, you need to look at how countries tax income. There are two core principles. The first is the source principle. This means if income is generated inside a country, that country has the right to tax it. The second is the residence principle. This means if you are a resident of a country, that country has the right to tax your global income, no matter where it is earned. Now think about what happens when these two rules collide. You live in one country, but you earn income in another. Both countries apply their rules at the same time. One taxes you because you earned the money there, and the other taxes you because you live there. That overlap is what creates double taxation. And without proper planning, it can easily take away 30 to 50% of your income. There are two main types of double taxation, and understanding them helps you see how the system works. The first is juridical double taxation. This is the most direct and obvious type. The same person is taxed twice on the same income. For example, you earn income in the UK and pay tax there, and then your home country taxes that same income again. The second type is economic double taxation. This one is less obvious but just as important. It happens when the same income is taxed in different hands. A classic example is a company earning profits and paying corporate tax, and then distributing those profits as dividends to shareholders who are taxed again. The income hasn't changed, but it is taxed twice through different layers. This distinction matters because tax treaties deal with these situations differently. Now, this is where double taxation agreements or DTAs come into play. These are formal treaties between countries designed specifically to prevent this problem. But here is something important that most people misunderstand. DTAs do not eliminate tax completely. They do not mean you pay zero tax. Instead, they allocate taxing rights between countries and provide mechanisms to make sure you are not taxed twice on the same income. In simple terms, they create rules about who gets priority and how relief is applied. There are three main methods used in these agreements. The first is the exemption method. Under this approach, one country agrees not to tax certain foreign income at all. So, if you earn income abroad, your home country may simply exclude it from taxation. This is one of the cleanest solutions because the income is only taxed once. However, it is not always available and usually applies only to specific types of income. The second method is the tax credit method, and this is the most commonly used approach worldwide. To understand it properly, let's go through a simple example. Imagine you earn £10,000 from the UK. The UK taxes that income at 20%, so you pay £2,000 in tax there. Now, your home country also taxes your global income at, say, 25%. Normally, you would owe £2,500, but under a tax treaty, your home country allows you to claim a credit for the tax already paid in the UK. So instead of paying the full £2,500, you subtract the £2,000 you already paid and only pay the remaining £500. The total tax aligns with the higher rate, but you are not taxed twice. This single mechanism can make a massive difference to your actual income. The third method is reduced withholding tax rates. This typically applies to passive income such as dividends, interest, and royalties. Without a tax treaty, these types of income can be taxed at very high rates, sometimes up to 30%. But under a DTA, these rates are often reduced significantly, sometimes to 10% or even 5%. That reduction directly increases your net income. And if you are receiving regular passive income, the long term impact can be substantial. Now, here is the most critical part that most people get wrong. These benefits are not automatic. Just because a treaty exists does not mean it will be applied to you automatically. You have to claim the benefits properly. This usually involves providing documentation such as a tax residency certificate, submitting the correct forms, and sometimes applying for relief before the income is even paid. If you fail to do this, the default tax rules apply, and you may end up paying full tax in both countries. This is where most people lose money, not because the system is unfair, but because they don't use the system correctly. There is also another advanced concept called tiebreaker rules. Sometimes both countries may consider you a tax resident under their domestic laws. In that situation, the DTA provides a set of rules to determine which country you are treated as a resident of for tax purposes. These rules usually look at factors such as where you have a permanent home, where your economic and personal ties are strongest, and where you spend most of your time. This prevents confusion and ensures that you are not taxed as a full resident in two different countries at the same time. When you step back and look at the bigger picture, double taxation agreements are not just technical legal documents. They are powerful financial tools. If you understand how they work and apply them correctly, you can significantly reduce your global tax burden in a completely legal way. But if you ignore them or misunderstand them, you could end up overpaying year after year without even realizing it. And when it comes to international income, those losses add up quickly. So, the difference between someone who overpays tax and someone who optimizes their tax position is not luck, it is knowledge. If you earn across borders, understanding how DTAs work is not optional, it is essential. And once you understand the system, you stop reacting to taxes and start controlling them. If you're earning across borders, this is not optional knowledge, this is financial survival. Subscribe if you want to stay ahead.